Hey folks, in this video, let's talk about India's economic prospects for 2025 and some key economic concerns. According to the print, India will remain the fastest growing major economy in the world and something that will make for good headlines. India is poised to cross Japan to become the fourth largest economy in the world in 2025. There are challenges, of course, starting with an uncertain global environment. On domestic front, uneven growth. Rural demand, which was struggling as India emerged out of the pandemic, is now picking up, whereas urban demand, which was strong as India came out of the pandemic, is now slowing down. Finally, the missing piece in India's growth story, like Lapata ladies, Lapata private investment. That is, private capital expenditure is yet to see a sustained pickup. Now, let's zoom into some key economic concerns about India's economy as we enter the new year. Number one, trade, specifically trade with the United States. If you look at financial year that ended in March 2024, United States was the second largest trading partner for India. Even the 2 years prior to that, US was the top trading partner for India. More importantly, though, US is the only country in this list of top 5 trading partners for India with which India runs a trade surplus. That is, India exports to the US way more than it imports from the United States. Look at the other 4 countries on this list. India imports a lot more than what it exports to these 4 countries. We can say US is probably the most important trading partner for India. What's the problem then? Donald Trump takes office as the US president in the second half of January 2025, and he will point America's attention to all those countries with which the US runs a trade deficit.
But here's the problem with Canada. So many friends up there. I love the Canadian people. They're great. But we're spending hundreds of billions a year to protect it. We're spending hundreds of billions a year to take care of Canada. We lose in trade deficits. We're losing massive. We don't need their cars. You know, they make 20% of our cars. We don't need that. I'd rather make them in Detroit. We don't need the cars. We don't need their lumber. We have massive fields of lumber. We don't need their lumber. We have to unrestrict them because stupid people put, restrictions on, but I can do that with an executive order. We don't need anything they have. We don't need their dairy products. We have more than they have. We don't need anything. So why are we losing $200 billion a year and more to protect Canada? And why should we have a $200 billion deficit and add on to that many, many other things that we give them in terms of subsidy? And I said, that's okay to have if you're a state. But if you're another country, we don't want to have it. We're not going to have it with European Union either. European Union, we have a trade deficit of $350 billion. They don't take our cars. They don't take our farm product. They don't take anything.
So the question is, will India be able to maintain the same level of trade surplus with the US? If not, that will certainly suppress India's GDP growth. Number two, Indian rupee depreciation against the US dollar. This is related to point number one. Since the election of Donald Trump, emerging market currencies have been under pressure, including the Indian rupee. Looking at 2024, the pace of depreciation of Indian rupee against the US dollar took off in the last 2 months of 2024. And in 2025, it appears that rupee will remain volatile as India and the US engage in trade negotiations. Number three, differential between government bond yields of India and the United States. In a well run nation, government bonds are considered to be the safest investment option. And among all the nations, US government bonds are considered to be the safest, almost as a risk free asset. In that case, why would a global investor then buy the government bond of any other nation? They'll do that only if that other nation offers a significantly higher interest rate or higher yield when compared with the US government bonds. And that's what Indian government bonds used to offer. Look at this chart from 2024. In the beginning of 2024, the spread between India and the US government bond yields was over 3%. That is, Indian government bonds used to offer 3% higher interest rates when compared with US government bonds. The problem, that spread has now narrowed from 3% to barely over 2%. That means foreign inflows into Indian assets are likely to get negatively impacted, and the borrowing costs for the Indian government are likely to go up. Not conducive for growth. Lastly, number four, private investment cycle or private capex. In the last few years post pandemic, Indian government spent heavily on building infrastructure. As a result, GFCF has grown by an average of 11% year on year in the last 3 years. And government was borrowing heavily to do all these things. That policy stance has now changed. Capex boost from the government has peaked. So if the GDP growth is to sustain, private capex needs to step in. Even though the corporate balance sheets in India are healthy, the credit to large industries in the last 3 quarters has barely grown by 6% on average, which is not impressive. That means private companies are not investing in capital assets. Add to that, the critical threshold for manufacturing capacity utilization is yet to surpass 75% in a sustained manner. And then there is China with its overcapacity in manufacturing. All these factors make it very difficult for India's private capex to kick in. And so, considering all these factors, as we begin 2025, Deloitte India expects the country to grow at about 6.5% during the ongoing financial year, way below the expectations of above 7% growth. Even the Reserve Bank of India has downgraded India's growth forecast on the same lines. So, we'll keep an eye on how things unfold here on out. I hope you found this analysis interesting. I'll speak with you again next week. Until then, take care.